The vast, interconnected web of global trade is the lifeblood of the modern economy. Yet it flows through veins perilously narrow. These are the maritime choke points, the literal straits of instability. Imagine $90% of global trade volume passing through just a handful of bottlenecks. The Suez Canal, the Strait of Hormuz, the Panama Canal, the Strait of Malacca. A disruption here is not a mere inconvenience. It's an economic cardiac arrest. In a world of just-in-time inventory, where components and finished goods cross oceans daily, these passages represent the fundamental fragility of globalization. A single event, a container ship wedged sideways, a regional conflict flaring, or a coordinated act of piracy, can instantly snarl supply chains spanning continents, triggering cascading price hikes and production halts. We're not talking about marginal cost increases. We're talking about systemic risk to the entire apparatus of capitalism. The sheer volume of oil, natural gas, and manufactured goods transiting these points means that any instability is immediately weaponized, affecting everything from gasoline prices at the pump to the cost of consumer electronics on the shelf. This vulnerability is an unpriced externality that global commerce has largely ignored, until it cannot. The recent surge in geopolitical tension has moved this risk from a hypothetical worst-case scenario to a present, palpable danger, threatening to redefine the cost of doing business and, critically, the economic security of the United States. Signs of this latent crisis often appear not on the ocean, but in the sterile data of financial markets. The earliest warnings manifest in insurance and commodity pricing. Specifically, we look at the war risk insurance premiums charged to vessels traversing regions like the Red Sea or the Gulf of Aden. These rates are a real-time gauge of perceived military or geopolitical danger. When they spike, it signals a significant increase in the operational cost for shippers, which is immediately passed down the line. Simultaneously, the freight forward agreements, FFAs, contracts that allow shippers to hedge against future rate fluctuations, become highly volatile. This financial nervousness is quickly reflected in key commodity futures, especially crude oil. A blockage in the Strait of Hormuz, through which approximately $20% of the world's daily oil consumption passes, causes the Brent and WTI crude futures to surge almost instantaneously. This isn't just speculation. It reflects a genuine fear of supply interruption. Furthermore, we monitor the sovereign credit default swaps, CDS, of countries strategically situated near these choke points. Elevated CDS spreads for nations like Egypt, Suez Canal, or Yemen suggest that the market is pricing in instability that could halt or complicate transit, further amplifying the perceived maritime risk. These indicators tell us the fuse has been lit long before the explosion occurs. The market volatility we just discussed is the quantification of what we might call the choke point tax. It is an unstated, variable cost baked into every global transaction, representing the risk premium required to move goods through a contested or narrow passage. Historically, this tax was minimal, a fractional percentage of the cargo's value. But, in an era of heightened geopolitical friction, this tax is spiking, dramatically altering the economic calculus for trade. Consider the simple price of a gallon of milk. If the cost of the plastic packaging, the diesel for the transport ship, and the insurance for that ship all rise due to a Red Sea transit detour, that cost is ultimately paid by the consumer in Cincinnati or Sacramento. Graphics showing cost breakdown of a single container, insurance, fuel, freight rate. Furthermore, this tax is not evenly distributed. Nations that are heavily dependent on singular choke points, like South Korea for the Strait of Malacca, or most of Central Europe for the Suez Canal, face disproportionately higher supply-side shocks, leading to more aggressive domestic interest rate hikes and faster erosion of their exchange rates. The choke point tax is thus a measure of vulnerability, and for the U.S. economy, It means importing global instability in the form of elevated and persistent inflation, undermining the very foundation of predictable economic planning. We do not need to look for hypothetical crises. The early 2020s have provided stark, real-world examples of this risk. The 2021 grounding of the container ship Ever Given in the Suez Canal, though temporary, offered a vivid demonstration. Within days, the blockage stalled an estimated $9.6 billion in trade, causing a ripple effect that exacerbated pandemic-era supply chain woes and contributed to the subsequent surge in global inflation. The immediate impact was felt in the spot freight rates, which skyrocketed, and in the sharp increase in liquidity strain for companies relying on just-in-time supplies. More recently, the ongoing geopolitical conflict near the Black Sea has restricted the flow of grain and fertilizer, creating immense pressure on global food prices, disproportionately affecting developing nations. These disruptions reveal a critical flaw. A hyper-efficient, lean global system lacks the necessary redundancy. When a lane closes, the capacity to compensate is almost non-existent. The financial markets initially treat these as isolated incidents, but the pattern of repeated choke point failures fundamentally shifts the risk profile of long-distance trade, demanding higher sustained premiums and encouraging a structural reassessment of global manufacturing locations. This is an environment where marginal efficiency is sacrificed for stability. To truly understand the risk, we must map the flow of strategic commodities. The Strait of Hormuz is perhaps the most critical. Its closure, even briefly, could vaporize a significant portion of the world's daily oil supply, triggering not just an economic shock, but a global strategic crisis. Similarly, the Strait of Malacca, a narrow passage between Malaysia and Indonesia, funnels roughly $40% of the world's seaborne trade, acting as a crucial conduit for oil, gas, and consumer goods destined for East Asia and the U.S. West Coast. Animated maps showing major shipping lanes and the volume of specific goods, oil, LNG, grain, transiting each choke point. The vulnerability extends beyond oil. The Bab el-Mandeb Strait, linking the Red Sea to the Gulf of Aden, is vital for global liquefied natural gas, LNG shipments. Disruptions here directly affect energy prices and, consequently, the manufacturing costs in Europe and Asia. The dependence on these arteries means that the market becomes acutely sensitive to even minor skirmishes or political rhetoric in adjacent regions. Any shift in the risk perception immediately translates into higher forward contract prices for these commodities and raises concerns about long-term liquidity in energy markets, forcing central banks to factor geopolitical risk directly into their monetary policy calculations. A disruption at a critical choke point does more than just delay physical goods. It fundamentally attacks the system's liquidity. Global trade relies heavily on short-term financing, primarily through letters of credit and trade credit insurance. When a major shipping lane is jeopardized, vessels are forced to take longer, more expensive routes, such as around the Cape of Good Hope, stretching delivery times by weeks. This extended cycle time means that the capital tied up in transit is immobilized for longer periods. Table comparing transit times, costs for Suez versus Cape of Good Hope routes. Banks and insurers, faced with higher political and operational risks, become reluctant to extend credit or sharply increase the premiums on trade insurance. For companies, this translates to a severe working capital constraint. If a firm cannot secure the necessary financing to bridge the gap between production and payment, even profitable contracts can become unfeasible. This immediate tightening of trade finance can cascade across the financial system, creating a credit crunch distinct from traditional monetary policy tightening. The flow of capital itself slows down, jeopardizing the smooth operation of global commerce and threatening a wider economic deceleration. The economic shock generated by a choke point crisis works through a phenomenon known as the bullwhip effect. This describes how a small change in end-user demand or supply availability at the retail level translates into exponentially larger fluctuations further up the supply chain. A 2-week delay in transit, for instance, might cause a retailer to panic order 20% dollars more stock to avoid shortages. The distributor, seeing this amplified order, might overorder 50% dollars from the manufacturer. Diagram illustrating the bullwhip effect in a supply chain. The manufacturer, fearing material shortages, then aggressively stockpiles raw inputs. This aggressive over-ordering, driven by uncertainty, creates an artificial surge in demand that strains production capacity and pushes up input prices globally. Once the supply line normalizes, the system is left with excess inventory, leading to sudden price corrections, cancellations, and potentially deep financial losses for producers. This vicious cycle of overreaction and correction exacerbates volatility, making business planning nearly impossible and contributing significantly to the current, unpredictable nature of real estate needs for warehousing and logistics facilities. Perhaps the most visceral impact of maritime instability on the ordinary citizen is the resultant inflation. When transit costs surge due to rerouting or heightened insurance premiums, this is fundamentally an increase in the cost of production and distribution. Since logistics costs are a factor of production, their increase results in cost-push inflation. The price of oil, a primary input for transportation, immediately transmits higher costs to every corner of the economy, from agriculture, fertilizer, and harvesting to retail. This is not merely an increase in the price of imported goods. Domestic producers who rely on imported components also face higher costs, which they must pass on to maintain profit margins. This phenomenon is reflected directly in the Consumer Price Index, CPI, making essentials like food and fuel more expensive. Chart showing correlation between global shipping costs, e.g., Shanghai Containerized Freight Index, and U.S. CPI, lagged by 3 to 6 months. Crucially, persistent cost-push inflation erodes the purchasing power of wages and savings, affecting real estate affordability and personal financial security. This instability makes the inflation outlook stubbornly persistent, challenging the assumption that domestic monetary policy alone can tame the rise in prices. The primary recipient of this imported instability is the central bank, most notably the Federal Reserve. A choke point crisis presents an agonizing dilemma for policymakers. Typically, central banks combat inflation by raising interest rates to cool demand. However, inflation driven by supply shocks and higher transit costs, cost-push inflation, is largely immune to demand suppression. If the Fed raises rates too aggressively to fight inflation, it cannot control. It risks plunging the economy into a deep recession without solving the underlying supply problem. Conversely, if it ignores the inflation, it jeopardizes its credibility and allows expectations to become unanchored. Graphic illustrating the Phillips curve trade-off under supply shock conditions. The market's reaction is critical. Investors demand higher yields on Treasury bonds to compensate for inflation risk, pushing up long-term interest rates and hurting the real estate and durable goods sectors. Furthermore, the crisis impacts the exchange rate. If the U.S. dollar strengthens as a global safe haven during instability, it makes U.S. exports more expensive but helps dampen imported inflation. However, the Fed's response must carefully navigate these domestic and international pressures, often resorting to unconventional guidance to manage expectations amidst profound uncertainty. To grasp the scale of current maritime risk, we turn to historical parallels, though few exactly match the complexity of today's interconnectedness. The 1997 Asian financial crisis, orchestrated by capital flight and weakened exchange rates, offers a crucial contrast. That crisis was primarily a financial one, stemming from structural weaknesses in banking and excessive short-term borrowing denominated in U.S. dollars. The IMF interventions focused on restoring domestic liquidity and rebuilding capital reserves. Image contrasting a financial crisis capital flight with a supply crisis, physical blockage. Today's threat, while having financial consequences, originates in physical blockage and geopolitical friction. When trade stops, regardless of a country's monetary policy, production ceases and prices rise. However, the 1997 crisis taught us the devastating power of contagion. Instability in one strategic region, like Southeast Asia for shipping, can quickly spill over, undermining investor confidence and driving up the sovereign credit default swaps, CDS, across all emerging markets perceived to be vulnerable to external shocks, whether financial or physical. This lesson underscores that maritime instability can rapidly transform into a broader financial crisis if credit lines seize up. Geographic instability near choke points directly translates into crippling economic strain for adjacent nations, often revealing deep structural vulnerabilities. Consider the cases of Greece and Turkey. While Greece's crisis was rooted in fiscal mismanagement and Eurozone structural flaws, proximity to unstable maritime routes and geopolitical friction in the eastern Mediterranean remains a constant economic overhang. This pressure keeps their sovereign credit default swaps, CDS, elevated, signaling persistent risk to investors. Turkey, controlling access to the Bosphorus and Dardanelles, vital for Black Sea trade, faces chronic currency crises. Political tension, often linked to maritime control disputes, immediately undermines confidence, leading to severe depreciation of the Turkish lira and making imported goods, from energy to components, ruinously expensive. This volatility impacts the nation's exchange rates and makes it incredibly difficult for the central bank to anchor inflation expectations. These examples highlight how the strategic value of a choke point can become an economic liability, subjecting the host nation to global risks that far outweigh its domestic policy strength. The impact of choke point vulnerability can be likened to the long-term, devastating economic erosion seen in nations like Argentina and Venezuela, albeit through different mechanisms. Argentina suffers from chronic reliance on agricultural exports and political instability that drives away capital, leading to cyclical defaults and astronomical interest rates. Venezuela's collapse, fueled by hyperdependence on oil and political isolation, demonstrates what happens when a single commodity flow is compromised, whether by sanctions or mismanagement. Comparison chart: Argentina, financial fiscal shock, versus Venezuela, commodity, political shock, versus choke point, supply shock. The common thread is the loss of predictability and confidence. Maritime instability, by creating highly volatile commodity prices and disrupting global trade financing, introduces a level of uncertainty that mirrors the systemic risks faced by these nations. For businesses and investors, the possibility of sudden, unpredictable delays or cost spikes fundamentally alters the risk premium, mirroring the kind of instability that forces investors to demand enormous compensation or flee entirely, ultimately undermining domestic economic development and exacerbating inflation. For a potent historical parallel, illustrating the immediate strategic and economic danger of a choke point closure, we examine the 1956 Suez Crisis. When Egypt nationalized the canal, leading to military intervention and the eventual closure of the waterway, the economic consequences were immediate and profound. Europe, heavily dependent on Middle Eastern oil transiting Suez, faced severe fuel rationing and an instant economic contraction. Crucially, this event demonstrated how geopolitical conflict could instantly weaponize a vital trade artery, forcing major powers to prioritize security over efficiency. The crisis caused freight rates to soar and highlighted the massive cost of rerouting ships around the Cape of Good Hope, an early, dramatic example of the choke point tax discussed earlier. While the global economy is far more diversified now, the lesson holds. The closure of a major shortcut fundamentally restructures costs and supply expectations, pushing the entire system toward higher risk premiums and threatening global liquidity by delaying the completion of trade cycles. The contemporary crisis surrounding the Black Sea serves as a stark reminder that choke point risks extend beyond narrow canals and straits to encompass critical seas and ports. The conflict there severely limited the export of grain, particularly from Ukraine, a critical global supplier of wheat, corn, and sunflower oil. This disruption triggered a wave of food price inflation worldwide, severely impacting developing economies dependent on affordable imports. The immediate financial fallout included spiking commodity futures and volatility in agricultural futures markets, forcing the UN and regional powers to scramble for temporary transit agreements. Image showing the route of grain exports through the Bosphorus Strait. This case study highlights a crucial point. Instability near a choke point directly impacts the exchange rates and interest rates of importing nations, as they must dedicate more capital to essential imports. It also exposes the humanitarian cost, proving that maritime risk is not merely an abstract financial problem, but a direct threat to individual lives through food insecurity, demonstrating the interconnectedness of geopolitical security and economic stability. The instability on the high seas rapidly converges on the U.S. economy through its critical port infrastructure, primarily impacting the West Coast gateways, like Los Angeles and Long Beach. When choke points are disrupted, vessels arrive in unpredictable clumps or delay their journeys, creating massive congestion and inefficiency at American docks. This backlog leads to soaring costs for drayage and warehousing, directly feeding into inflationary pressures. Furthermore, this stresses the domestic logistics backbone, driving up the cost of industrial real estate, specifically warehouse and distribution center leases, inland near major rail hubs. Higher costs and delays force U.S. manufacturers to hold larger safety stocks, tying up significant amounts of capital and reducing corporate liquidity. The entire logistics chain, from the Suez Canal to a distribution center in Illinois, is effectively one system. When the global segment falters, the domestic segment bears the inflationary burden, making American supply chains less competitive and ultimately increasing the cost of goods for every U.S. consumer. The reverberations of maritime instability are not uniform. They are acutely felt in sectors dependent on complex global assembly lines. The automotive industry, relying on thousands of components sourced from across Asia, is particularly vulnerable. A choke point delay can halt an entire assembly line for lack of a single specialized microchip or subassembly, leading to massive financial losses and production backlogs. Similarly, the consumer technology sector faces frequent delays in product launches and escalating costs, challenging their lean inventory models. This recurring instability has shattered the decades-long promise of globalization, that maximum efficiency achieved through fragmented production was always the optimal economic strategy. The resulting uncertainty in forecasting supply and demand causes companies to demand higher risk premiums, which manifests as upward pressure on corporate borrowing costs and contributes to sustained high interest rates. This forces a painful strategic reevaluation, pushing businesses to consider costly nearshoring or reshoring initiatives, a fundamental shift away from pure efficiency toward resilience. The cumulative effect of the choke point tax and sustained shipping disruption weighs heavily on the U.S. balance of payments. America's long-standing trade deficit, where imports consistently exceed exports, means that the nation is structurally exposed to escalating import costs. When maritime risk increases, the cost of the vast quantity of goods the U.S. consumes rises disproportionately. This isn't just a cost for businesses, it's a transfer of wealth. Higher import prices act like a tax on U.S. consumers, exacerbating domestic inflation without adding commensurate productive capacity. Chart comparing the U.S. trade deficit trajectory with global maritime insurance costs. This reality makes the U.S. economy profoundly sensitive to the stability of faraway straits, forcing policymakers to treat maritime security not just as a defense issue, but as a primary component of economic stability. Furthermore, if foreign exporters become hesitant to ship goods due to political risk, the scarcity of key imported components can undermine domestic production, leading to a loss of competitiveness and potential job losses in import-dependent sectors. The instability, imported via maritime chokepoints, presents an acute governance challenge for the Federal Reserve. The traditional tool of raising interest rates is designed to curb demand-driven inflation. However, inflation caused by supply shocks, cost-push inflation, originating from higher shipping, fuel, and input costs, is largely impervious to domestic demand management. If the Fed responds aggressively to high CPI readings with steep rate hikes, it risks severely contracting economic activity, hurting employment, and crashing the real estate market, all without alleviating the root cause, the cost of transit. Graphic illustrating the dilemma: Fed's interest rate response versus supply-side inflation source. This leaves the central bank in a difficult position. It must manage inflation expectations while acknowledging the exogenous nature of the shock. If global shipping disruptions become structural, it implies a permanently higher floor for input costs, forcing the Fed to accept a trade-off: either structurally higher sustained inflation or a lower recessionary growth path. This uncertainty complicates monetary policy transmission and heightens financial market volatility. Recognizing the limits of monetary policy in addressing a physical supply shock, the U.S. government must rely on executive and strategic tools. One key response involves the strategic deployment of the Strategic Petroleum Reserve, SPR. A blockage of the Strait of Hormuz, for example, could be temporarily mitigated by releasing oil from the SPR to stabilize global supply, aiming to cool crude oil futures and curb immediate cost-push inflation. This is a temporary measure, buying time but not solving the underlying geopolitical risk. Furthermore, diplomatic and, in some cases, military actions are deployed to ensure the freedom of navigation through critical areas like the Bab el-Mandeb or the Suez approaches. The government also seeks to foster greater liquidity in global trade finance through guarantees or support for multinational development banks, ensuring that trade credit does not completely seize up during periods of high risk. However, these governmental interventions carry fiscal costs and potential geopolitical escalation risks, highlighting the immense expense required to maintain the stability we often take for granted. Ensuring the flow of global trade requires coordinated strategies that blend economic leverage with security measures. The U.S. and its allies engage in complex economic, military diplomatic interventions to manage choke point risks. This includes forming multinational naval task forces to patrol high-risk shipping lanes and conducting joint exercises to deter aggressive non-state actors or hostile nations. Diplomatically, the U.S. leverages international institutions to pressure regional actors into maintaining the neutrality and accessibility of waterways, using trade agreements and sanctions as carrots and sticks. Economically, investment in alternative routes, such as rail corridors or pipeline projects designed to bypass vulnerable sea lanes, is gaining traction, though these are long-term, multi-billion-dollar endeavors. Map showing alternative trade routes, like the International North-South Transport Corridor, INSTC, or proposed bypass pipelines. These interventions are necessary because market mechanisms alone cannot secure these public goods. The cost of intervention, however, is substantial, diverting capital from domestic priorities and placing a permanent geopolitical premium on the cost of global commerce. This constant tension between efficiency and security is a defining feature of the modern economic landscape. For the individual viewer, the instability emanating from distant straits translates directly into uncertainty regarding jobs, savings, and cost of living. The first practical strategy for survival in this environment is aggressive management of personal liquidity. When supply shocks trigger sudden bouts of inflation, and central banks respond with high interest rates, access to quick cash becomes paramount. Individuals should aim to maintain a robust emergency fund, ideally covering 6 to 12 months of expenses, held in liquid, low-risk accounts. This buffer protects against unexpected job losses stemming from supply chain disruptions, e.g., factory shutdowns due to component shortages, or sudden spikes in necessary household expenses, like fuel or food. Graphics showing ideal personal emergency fund savings target based on expense coverage. Relying heavily on credit cards or short-term loans in an environment of increasing interest rates linked to geopolitical stress is financially perilous. The ability to weather short-term income disruptions without resorting to high-cost debt is the primary defense against global economic contagion impacting individual lives. Another crucial survival strategy involves managing exposure to volatile prices and debt in a cost-push environment. Since supply shocks create persistent, high inflation, individuals should be proactive in building reasonable reserves of non-perishable consumer goods and energy if feasible, e.g., locking in favorable energy contract rates. More importantly, examine personal debt portfolios. If central banks are forced to maintain high interest rates due to imported inflation, individuals with significant variable rate debt, such as adjustable rate mortgages or certain credit lines, face escalating payment burdens. The practical insight here is to prioritize locking in fixed-rate financing wherever possible to insulate household budgets from the volatile responses of the Federal Reserve to global risk. Table comparing fixed-rate versus variable rate loan payments under rising interest rate scenarios. The cost of servicing debt is directly tied to the perceived geopolitical stability of the global trade system. Protecting your family's financial stability means recognizing that a flare-up near the Strait of Hormuz could ultimately increase the minimum payment on your home equity line of credit. For long-term financial survival, the instability inherent in choke points necessitates a strategic shift in investment philosophy, moving away from hypergrowth and toward inflation protection and resilience. Diversification is key. Individuals should reduce overexposure to sectors heavily dependent on fragile, just-in-time global supply chains, e.g., certain manufacturing ETFs. Instead, consider inflation hedging assets. This includes Treasury inflation-protected securities, TIPS, which adjust their principal based on the CPI, and potentially real assets like commodities or commodity-linked funds, which tend to perform well when maritime shocks push up raw material prices. Furthermore, real estate, particularly logistical and storage assets, can serve as a hedge, as the demand for resilient warehousing near U.S. ports increases during instability. Infographic illustrating the portfolio allocation shift from growth stocks to inflation-protected assets, tips real assets during periods of high geopolitical risk. The practical insight is to acknowledge that the era of low, predictable inflation may be over, and portfolios must be structured to sustain purchasing power against persistent, cost-push shocks. The structural shift away from fragile global efficiency towards local resilience offers a practical pathway for individuals to mitigate choke point risks through consumption choices. This means prioritizing nearshoring and localizing consumption. By favoring goods produced domestically or regionally, consumers reduce their reliance on intercontinental shipping routes subject to geopolitical instability, thereby mitigating exposure to the choke point tax and unpredictable inflationary spikes. While this often comes with a slightly higher initial price point, it provides a crucial buffer against the volatility associated with distant supply chain failures. Furthermore, this trend impacts the real estate market, driving demand for industrial facilities in domestic production hubs and supporting local job markets. Chart comparing price volatility of domestically sourced versus globally sourced goods during a shipping crisis. The practical insight is understanding that every purchasing decision is also a decision about supply chain risk management, allowing individuals to actively reduce their personal exposure to global maritime instability and its impact on their daily budget and individual lives. The repeated failure of maritime choke points is forcing a fundamental, philosophical pivot in economic thinking, moving away from an obsessive focus on efficiency and toward a premium on resilience. For decades, the goal was to minimize inventory, reduce transit time, and drive down marginal costs. This lean, just-in-time system proved brittle when faced with geopolitical friction. The new paradigm acknowledges that carrying extra inventory, diversifying suppliers across different continents, and investing in multiple transport modalities, even if initially more expensive, is a form of insurance. This investment in resilience comes at a cost, likely contributing to a slightly higher, more persistent level of baseline inflation globally. Table comparing efficiency-focused supply chain, low cost, low inventory, high risk, versus resilience-focused supply chain, higher cost, diversified, lower risk. Governments and businesses must now measure economic success, not just by GDP growth or quarterly profits, but by the system's ability to withstand a major external shock without systemic collapse. This shift requires long-term capital commitment, impacting everything from infrastructure bond yields to corporate investment strategies. The instability mapping the choke points imposes not only financial costs, but profound ethical and geopolitical costs. When supply chains are weaponized or disrupted, the poorest and most vulnerable nations often suffer disproportionately, facing acute shortages of essential goods like food and medicine, as seen in the Black Sea grain crisis. This vulnerability leads to increased internal instability, refugee flows, and heightened regional conflicts, a vicious cycle where economic pressure triggers human crises. Furthermore, the reliance on naval patrols and security forces to guarantee trade freedom militarizes global commerce. The defense of economic interests becomes inextricably linked to military presence, raising the global temperature and increasing the probability of direct conflict. Image illustrating the economic disparity, impact of food price inflation on developed versus developing nations. This dynamic forces nations to confront the moral hazard. Is the pursuit of maximum economic efficiency worth the elevated risk of war and the disproportionate suffering inflicted on non-participating nations? The long-term costs of this instability threaten to undermine the international order that made such globalized efficiency possible in the first place. The only long-term solution to the Straits of instability is a commitment to robust global cooperation and enforceable maritime governance. Nationalistic approaches focused solely on military defense offer only temporary, expensive fixes. What is needed is a strengthened international framework, likely under the auspices of the United Nations or the International Maritime Organization, IMO, to guarantee the non-politicized passage through designated international choke points. This requires binding agreements on non-interference and shared security responsibilities. Economically, this means establishing multinational funds to subsidize alternative transport routes or invest in local production capacity near consuming markets, thereby reducing the systemic reliance on single routes. Diagram illustrating the structure of the International Maritime Organization, IMO, and its role in regulating shipping. Furthermore, there is a critical need for transparent global data sharing regarding shipping risks, freight rates, and liquidity pressures to reduce speculative volatility in financial markets. This commitment to shared economic security must override short-term nationalistic or geopolitical gain, acknowledging that true stability is a global public good. We have mapped the Straits of instability, tracked the volatile price signals, and analyzed the cascading economic shockwaves. The ultimate, thought-provoking message is this: economic stability is not a default setting. It is an ongoing, expensive, and fragile geopolitical achievement. For generations, we allowed the quest for marginal efficiency to erode the crucial element of redundancy in our supply chains, outsourcing risk to remote, politically volatile regions. Now, the bill for that complacency is being paid in the form of persistent inflation, high interest rates, and elevated sovereign credit default swaps. The fragility of a single choked waterway reveals the interdependence of our global fate. For the individual, this means recognizing that financial planning must now incorporate geopolitical uncertainty. For nations, it means reevaluating the trade-off between global efficiency and domestic resilience. The future will be defined not by who can trade fastest, but by who can endure disruption best. The sea lanes that connect us are also the fault lines of the next economic crisis. Our prosperity flows through these narrow, perilous gaps, and only through vigilant security and structural economic change can we navigate the coming instability. How does this story resonate with you? I'd like to hear your perspective, so feel free to share your thoughts in the comments. If you found this video useful, consider subscribing and giving it a like. Thank you for watching, and I'll see you in the next video.